Saving for retirement can be difficult. Many Canadians find themselves in a situation where retirement is 15, 10, or even 5 years away, but they don't have nearly enough saved. They may realize that getting to their retirement goal using more traditional investment strategies and products is going to require some very serious and uncomfortable lifestyle changes. This combination of factors may cause many people to turn to seemingly sophisticated or private-sounding investment strategies to get them to their retirement goal. I used to wonder how people could be drawn into these types of investments. Then, a couple years ago, I came across a great piece of writing by my friend Markus Muhs, a senior portfolio manager at Canaccord Genuity Wealth Management in Edmonton. His article explains why people who feel like they're behind on their retirement savings may turn to investment fads and schemes. His article was an eye-opener for me, and I've shared it with many friends and clients since then. I invited Markus on the channel today to have a conversation with me about it. We talked about why people in their 50s and 60s are susceptible to falling for investment fads and schemes, stories from his nearly 2 decades working with Canadian retail investors, different types of risky investments that can draw people in, and Markus shares some words of wisdom that may help you avoid being pulled into a risky investment scheme. And with that, let's go to my interview with Markus Muhs. Markus, I appreciate you doing this today. So for the viewer, Markus and I met through the Financial Planning Association of Canada, which is a group that we're both a part of. And I've mentioned FPAC on the channel before. But before we met, I still am a fan of Markus's writing. And Markus writes on a blog that he keeps on his website. And we'll link to Markus's information in the show notes below. Through FPAC, Markus and I started chatting. And the topic a couple years ago, Markus, you might remember this, I was asking you about doing a newsletter. And you have been doing a newsletter for your clients for some time. And you shared an example of that with me, which included like a video and some articles. And I liked it so much that I actually implemented that in my practice. So anyone who watches these videos and follows my newsletter, that's really information that I picked up kind of, watching what you're doing and just saying, hey, Markus is doing this. And it seemed like a pretty scalable way to do a newsletter. And it's been part of kind of my weekly routine ever since.
If I can make a plug, that newsletter is available to everybody, not just clients, just
Perfect.
on my website, bottom of my website. And I wanted to say too, I'm a big fan of your work. Watch your YouTube videos. I share them quite often on my newsletter when it's a good one.
Awesome.
Most of them are pretty good.
Awesome. Yeah. Hey, they're not all great, right? Anyone, and I know you create content too. Some days, some weeks you feel like you hit it out of the park, and then some weeks you're like, oh, I didn't really do great. And what's funny is when you do these, when you create content, I don't know if you had the same experience. Sometimes the ones that you don't think are really that great are the ones that really resonate with people. And then on the flip side, the ones that you spend tons and tons of time on, sometimes they just sort of fall flat and nobody's that interested, right? But the reason that I wanted to bring you on today, Markus, is to talk about an article that you wrote back in 2022 that had to do with investment fads, and to sort of set up the conversation. Like, I work mostly with people that are approaching retirement or in retirement, or for whom retirement is like their primary financial goal. And I would sit with folks and I would hear about some of the things that they would ask me about, investment ideas, investments that they were part of, that immediately sort of struck me as being like, wow, this is really risky for somebody who's in your situation. And these are like really smart, dialed in people. And I'd leave those meetings thinking like, how could folks kind of be caught up in these types of things? And initially I thought it was maybe a greed thing. They're reaching for these really high returns because it's like a greed thing. They want more, right? And when I read your article that you wrote back in 2022, like, it was sort of a light bulb moment. Like, maybe it's not so much a greed thing. It's more of a, willingness to believe something that maybe they otherwise should clue into, maybe is a bit of a stretch. And that light bulb moment kind of came when I read your article. And since then, I've shared it a number of times with clients when I've talked to them about some of these sort of riskier investments. So I thought maybe we'd start with the question about why you believe people that are in their 50s and 60s that are approaching retirement might be more susceptible to falling for an investment scheme or some sort of investment shortcut.
Yeah, I found the same thing you did, that a lot of my clients in that age range, 50s and 60s, there's one particular, I'm not going to name any names, but one particular investment that is very prevalent in Alberta among, I don't know if it says big in Ontario as well, but it had its starts in Calgary, real estate investment that buys undeveloped land, develops it, and then sells it. And it's been going through some bankruptcy issues lately. And I find almost every one of my clients of that age range has invested some money in that particular company. And I think part of it is just they have really good sales forces. And those sales forces go out and they say, hey, you're an accredited investor and you can buy this. So they'll basically get my clients to invest a chunk of their RSP in it.
Hmm.
What I found is, so this particular blog post you're referring to, it's part of a series of posts that I wrote for basically people of different age ranges. What are some of the top things I can think of for people in their 20s, 30s, 40s, 50s? And again, I'm thinking about my typical client in that age range. And that got me thinking about that typical client in their 50s. That is where I kind of see more of those types of investments, or they might be interested in investment fads like cannabis stocks or whatever. And what is driving that? And I don't think it is greed, just like you said. So when I was doing these posts, 30s, 40s, 50s, the information I kind of shared the insight, and I think you can also share this kind of insight to clients because we have so many clients of different age ranges. We know how much a retired person is spending to live a comfortable lifestyle, right? And we know that typical client in their 40s who's planning for retirement, if they're in a we do their financial plan on Conquest, and who's the client who has a perfect retirement plan for themselves? How much do they have today in their 40s? And so that's the kind of stuff I'm sharing. And I realize there are a lot of people that aren't keeping up with this. So, if you're in your 40s and you want to have a comfortable retirement, what I kind of figured amongst my clients in that age range, the ones that are going to be comfortable have $500,000 to $1 million already saved up, or they have a good pension plan, a defined benefit pension. But there are a lot of people in their 50s that just don't have that saved up. And if they look at their retirement planning and they want to retire at 65 and have a comfortable income, people like you and me, we're telling them you got to save thousands, 5,000 a month or some crazy number that's just out of reach for them. So for them, they look at that retirement plan, investing in a diversified portfolio. Maybe it's a balanced portfolio because their time frame is a bit shorter, and they're just not interested in that. And they're looking to swing for the fences to try to make that retirement plan work. And that's what I think compels them into these types of riskier investments.
What are the most common forms of these risky investments that you see as you're coming across them in your clients?
I'll go back to one I mentioned in the blog post, which is the first one I saw back in 2008 when I was still fairly new as a financial planner. 2008, were you already around at that time in the business?
I was not in the business in 2008.
Give
I
something else.
started
Your
in
father
around
was, right?
2000. That's right. I started in around 2017. So
Okay.
I missed 2008. I definitely experienced it as an investor, a very early
Mm-hmm.
investor. It didn't
Mm-hmm.
really impact me that much because the amount that I had saved up wasn't that great, but I definitely read a lot about that time for sure.
That's a topic for another day, is how our investment experience is so hinged on when we started investing. Because I too that's when I started to have more money invested. And that was my first big crash in '08. But so if you think back to '08, the financial crisis, mutual funds were not doing well. I was at a bank in a financial planner role. Our main bread and butter was mutual funds. And a lot of clients were not so enthusiastic about mutual funds all of a sudden because the markets were crashing. And here's this company. I think I'm okay to name them because they've gone under. And they were very prevalent here in Edmonton, at least on local radio, their advertisements. FRPL Finance is what they were called, Fairmont Properties. And at first, you think that, is this something to do with the hotel chain? No, it's got to do with timeshares in Fairmont, BC is kind of where they got started. And their business model was basically buying back these timeshares and redeveloping them. And they were advertising on the radio with, I forget exactly what type of returns they were talking, 10, 15%. Sounded attractive. And if you think about, if you're invested in a mutual fund portfolio with your bank or wherever, and everything's down 20%, it's looking ugly, and you're hearing these radio ads, 10, 15%, guaranteed, they said. That's very attractive. My financial planning team at the bank, we were a team of about a dozen or 15 of us in South Edmonton. I was tasked among my team members to find out some more information about this because all of us were hearing about it from our clients. And so I went and actually got the prospectus from them. I posed as a potential investor and I looked through it. And at the same time, actually, I had a coworker at the bank whose father just bought into this thing. And I was like, watch out, make sure he's reading this, do his due diligence. This is not risk-free. And that's the issue, is just it's presented as being fairly low risk, or it's perceived that way. People think this is a mortgage type investment or it's real estate related. So it's less risky than stocks or stock mutual funds. And that's what compels them into that, and these high returns. And so reading the prospectus, I read in the fine print towards the end really is the guarantee hinges on us being able to sell this investment to someone else or sell this property to someone else. And
Right.
that
It's
kind of didn't
guaranteed as
happen.
long as this other really risky thing happens in order, right?
Yeah, and that didn't really happen because real estate prices did what they did post 2008. There's nothing illicit about this investment, I should say. It's just the fact that it was a lot riskier than people perceived. And it went through some kind of restructuring. The last I could find online about it was from 2010 when it went through restructuring. And so I don't know what really happened to the investors of it. I don't have contact with that former coworker of mine. But that's a big one, I noticed early in my career. Another one that was very prevalent in Edmonton on Edmonton radio was one from I call him the Diamond Huck huckster. I'm not going to name names because I don't know what he's doing these days, but he had a radio program. It was weekly on local talk radio. And in every program, he was basically scaring the investor about what's happening in the markets, what's happening in the news, why you shouldn't buy stocks or mutual funds, and why you should be investing in these fancy colored diamonds. This is the path to riches or whatever. I mention this because I hear from clients in that age range. I hear from clients about this. And if something that I'm recommending isn't working, like mutual funds at a time when the markets are tanking, which always happens on a regular basis, that's when people are looking at these other options. And yeah, if I've been saving all these years, I'm 50 and I can't make my retirement goal, and now the markets are down 10, 20%, of course I'm going to look at other options.
Mm-hmm.
And that's where they get compelled into these investments.
It sounds like it's just a human nature thing, right? You see yourself as being down, you want to rack up some quick hits. You then turn to, someone that appears credible, or at very least, has a sales pitch that sounds attractive.
It's a bit of an action bias. You're feeling what I'm doing isn't working. You have to look at what you're doing though in the longer term. Look at it over 10, 20 years and it is working. But if we're looking at it just over the last couple of months, or my investment statement is down, I'm falling behind, I got to do something. And then the other thing people get attracted to as well is fads. That's the big one. We saw cannabis a couple of years ago, maybe crypto, although I think crypto among that age range hasn't been as popular just because it's a little harder to understand. I don't even fully understand it. Maybe now it's AI investments. You look at the stock that did really, really well last year. Why don't I have more in that investment? I'm in a diversified portfolio, a factor-based diversified portfolio that happens to be a little bit heavier in value stocks. It's underperformed last year. And so those people are maybe looking at what did well. Maybe I should just own the Qs, the NASDAQ ETF. That stuff happens too.
What words of advice can you share or do you give to people when they come to you with these sort of ideas, investment ideas?
The biggest thing I think in terms of avoiding these super risky things is knowing the risk-free rate of return and how risk is always correlative with return. And there's never an exception. And that's where people, I think, fool themselves when they believe there is an exception. When they hear 10% guaranteed returns, that investment, if it's promising 10%, and if the GIC at your local bank, nowadays GICs are in the threes now, again, they're in the mid threes. And I post GIC rates on my newsletter too, not to sell them, but to just let people know this is the risk-free rate. If you want 1 year, 2 year, 5 year, you're getting 3-point-something%. Anything offering a higher rate of return has higher risk. Stocks have higher risks. Stocks have slightly higher expected returns. And what do we use for expected returns with stocks with Conquest? Like 6% or so, right?
It's like in the
Nothing
6%.
super high.
Yeah. Yep.
Something's offering 10%. It's even higher risk than stocks. There's no exception to this.
Yeah.
And if you once you understand that the financial markets are pretty efficient. So if there's an investment that is offering 10%, and if it really was low risk, everyone would be piling their money into it and basically arbitraging down that return so that that return ends up being what it should be, a low risk return. If it's at 10%, it's because that company was not able to get a loan at the bank. The bank would love to throw money at something earning 10%, right? If it was truly low risk, but it's obviously not. If I can get a mortgage at 4-point-something nowadays, or an unsecured loan at less than 10%, why is this business that's offering this investment at over 10%? Why are they paying over 10%? And also, where's that money come from to pay that, right? So anyways, that's the biggest thing, is knowing the correlation between risk and return and always being skeptical of those things offering a higher rate. The other big one too, I would say, and we kind of touched on fads a little bit. If something's crypto related, that should be a red flag. I'm very, very biased against crypto related investments. That might be a fault of mine. I've had some disagreements online, but there's so many instances where an investment is talking about a crypto type of investment, or if someone's asking you to send money via crypto, there's often it's scam adjacent, or it's just a weird investment scheme that you don't really need to be involved in. You don't need to have crypto in your portfolio. One last thing too is if you are going to take the risk, and know that I'm not talking about everything being a scam. There's a lot of things that are just schemes. They are investment strategies that are higher risk, but they might be legitimate strategies and might be worth taking that extra risk. Sometimes things do work out, but just know that it's a higher risk. Use a smaller amount of your capital. Don't put an entire investment account into whatever is being sold, and never ever do it with registered money. And you'll often see these things advertised on social media or the radio or whatever as being RRSP eligible. And that's just because whoever's selling it is trying to make this more appealing. I guess, a lot of people only have registered money. They only have money in their TFSA, RSP, or whatever, and they're trying to get that money invested in this. But with registered money, you run into a couple of other pitfalls. And one being, and this is also from my experience, I think I mentioned in the blog post, I mean, one is TFSA money. You don't want to invest TFSA money in this because if that goes to zero, you lose that contribution room forever. If you have non-registered money invested in one of these risky things and you lose it all, at least you have a tax write-off, you have a capital loss you can deduct against your gains. With RSP money, it's even more dicey. That's RSP money or locked-in RSP money. I mentioned locked-in RSP because oftentimes these investments are being sold by sales forces. They're often exempt market dealers, and they are just looking to sell what they can to whomever they can. They're just trying to make sure you're an accredited investor. We can identify you as that on the account opening docs. And where do you have money, Mr. and Mrs. Clients? You only have this pension plan you transferred from wherever in a locked-in retirement account. Well, yeah, sure, we can invest that money. Then what happens is, let's say you're in your 50s or 60s when you get into this. Now you have to, at some point down the road, convert your RSP into a RIF. Here's a real-life example I saw when I was at the bank. Guy was in his 90s, I think, or late 80s, and was in what was some sort of a mortgage investment. Again, it looked low risk. It was a local company in Edmonton, and he put $100,000 into this thing. Obviously, that's what he had in his RSP. I believe he was a teacher. He had some kind of pension plan, so he was in good shape in terms of having a pension income, but he had about $100,000 saved up in an RSP or a RIF, invested the entire thing in this product, and now had to take annual withdrawals, minimum payments. And whatever this company was, it went through its own restructuring, bankruptcy, whatever. It had not been marked down to a $0 value yet. It still had a value based on its last trading date because it was still going through a process.
Wow.
And that process can take years. And he had to
no
make
liquidity.
There's zero liquidity. And that's the other big thing is these investments, they are almost always of low liquidity. And in this case, sometimes they can become completely illiquid. So in his case, he had to take at his age about 10% or more each year in minimum payments. And what he was being offered by the trust company was basically take the investment in kind and move it out of the RIF and into a non-registered account and then pay the tax on it. So not only did he lose all of his money on this investment, it effectively was worth zero, although it wasn't on paper, but he also had to pay tax on it. So take that $10,000 chunk and pay his marginal tax rate, 30, 40% on it. It's a double whammy. Again, if it was non-registered money, none of that would occur and he'd potentially just be able to write it off. If he had stocks, publicly traded stocks in his RIF, those at least, they fluctuate daily and his RIF payments would be based on whatever the value was at the beginning of the year, not a made-believe value. Yeah, so don't use registered money. And usually if all you have is registered money, I'll just be honest, you probably aren't really an accredited investor. You're being identified as such because maybe your income is higher. There was one case I saw, this is a prospective client that came my way years ago. He worked in the oil industry and had this big pension from an oil company. And at some point, someone sold him on that real estate deal that I talked about earlier and had his entire locked-in account in this investment. And this particular company has not gone bankrupt and it has been starting to pay out its investors, but it took years and years. And this money was just locked in there and basically had no real value for a while. But again, it's because someone identified him. He was not a sophisticated investor, but someone identified him as accredited because he had a pretty high income, good six-figure income. And remember, there will always be those people who try to identify you as accredited and sell you these investments, but it might not really be right for you because the investment's illiquid and it's much higher risk than you perceive. The other thing too I just mentioned is don't ever buy an investment that's advertised in any form. If it's advertised on the radio or a billboard or even on the financial news networks, if an investment has to advertise, it's because good advisors like you and me, we're not recommending it for our clients. And maybe the investment is not compelling enough for investors to be flocking into it. But if it's being advertised, why is it being advertised? And you can just ignore that. There are plenty of other investments that aren't being advertised and that are fine for you. You can ignore the ones that are being advertised. And that will probably help protect you from a lot of those weird schemes.
This has been awesome, Markus. I appreciate it. I did not give Markus a heads up that I was going to ask him this question, but Markus, you're also working on a podcast with one of your colleagues. So can you talk a little bit about what you're doing and where people can find you?
Yeah, so you can find all my contact at muhs.ca, muhs.ca.
I'll link to your website in the show notes as well.
Yeah, my newsletter, you'll find my content. And what I do with every newsletter is I share a bunch of other good content I read online. That includes Mark's videos occasionally, includes stuff that we often co-contribute on in FP Collective. So just whatever I find is really worthwhile, once a month I send that out. The podcast I do with my colleague Justin in Calgary, what I've been doing recently actually is reviewing these particular posts that I'm talking about, and we've been recording a podcast episode for each of them. We've done for 20, 30s, and 40s. We still have to record for 60s, 70s. I think we'll skip 50s and maybe just post a link to this video.
Nice.
Because it covers a lot of that area.
Perfect.
But just having a discussion around that. Justin's another advisor in Calgary, and he's got some other good input in a lot of areas. And yeah, that's what we've been doing. And, we've been struggling to get that along. We've got those, the podcasts are now in YouTube format. We don't get quite as many views as you do, Mark. Don't have quite as many subscribers, but we're getting there. We're getting a few more. I think we have 50 viewers of our last one.
It'll be kind of like little bits, and then all of a sudden it just sort of grows, and it's all relative, right? Like my subscribers have kind of recently ramped up, but then it's all dependent on who you're comparing to, right? Like there's friends of ours that have hundreds of thousands of followers, and I guess we're all aspiring to get there, right? Thanks again, Markus. I appreciate it.
All right. Thanks for including me here.
Thank you for watching my interview with Markus Muhs. If you want to find Markus, I've included his contact information below, as well as a link to his website, his podcast, and social media accounts. If you have any questions or comments, please leave them below. And if you haven't already, please like this video and subscribe to the channel. And remember to hit that bell icon so that you're alerted when new videos are posted. Thanks again, and I'll speak with you soon. Take care.